Hello everyone, I am your host, The Cowboy. This is Elliott with Cafe. It is Thursday, March 31st, and today is the last episode of the chart of the day here for YouTube. And we're going to end the week by taking a look at the SP500, and I want to show you a little bit my counts and what's going on here, longer time frame, what's happening with this little sell-off that we've gotten, for the past couple of months in here, and then with the little retracement that we seem to be in the middle of. So before I jump to the S&P 500, I want to take you and talk a little bit about the yield curve. You've been hearing, quite some heavy talks about the inversion of the yield curve. What does that mean, for stocks? What is the yield curve? Why is everybody kind of freaking out about it? And I want to take you and kind of show you some charts, and we can kind of dive in that discussion, then come back and take a look at the S&P 500 and see how much of a fear we should have of an, upcoming large sell-off, an upcoming recession, things of that nature. So let's take a look at the yields in here. So the yield curve is basically, an upsloping line where I'm going to take you actually to this dynamic yield curve in here. It's an upsloping line that basically shows you that the interest rates for shorter duration maturities in here, for the 3-month, 6-month, 1 year, 2 year, the government usually pay you less in interest when you lend the money versus lending the money for a much longer time. So if you go 10 year, 20 year, 30 years, you should be compensated, with the higher rate of return, because you are assuming that there is higher risk of things happening in the future. So the probabilities of things going wrong in the shorter term, it's much smaller than that of those going wrong, let's say, on a longer term time frame, right? So that's why you usually get lower yield on your money lended to the government than what you're getting on a longer term. So this is kind of how the yield curve looks like right now. And I have a little red line in here that shows you the price, and the chart here to the right is the S&P 500. And I can slide this over and just kind of show you what a normal yield curve looks like. So for example, back in here, looking at about, let's just pick 2010, 2011, you could see, right, that the yield on the 3-month was very, very low, almost close to zero. And then as it was climbing back into the 2-year, it just kind of continues to go. And you are probably going to get, for a 7-year maturity, somewhere in the 2%. For a 10-year, you would get about 2.3. And then as you go up higher, somewhere in the 3.5 and maybe even 4% for a 30-year, right? So this is a normal yield curve that's upsloping, and that shows, let's say, a normal growth, a healthier economy, something where the investors, don't necessarily fear, upcoming negative news or a downturn in the economy moving forward. Then if you're kind of coming back here before the crash of 2008, you can see what they mean by the inversion of the yield curve, right? This is what you're kind of getting, right? Right there, right? Where you're getting the shorter term maturities in here, 3 months, 6 months, 1 year, that will pay you more than the 30 years, or almost the same. So if you look at the 7-year to 3 months, right, or the 7-year to 1 year, this is inverted. You're getting paid more for shorter term duration than for longer term duration. What this means is that, the customers, right, the clients, the investors, they ask you for more money up front, the bond market, because they perceive that something bad is going to happen in the future. So they want to kind of be compensated for that. And they think this is going to happen, fairly soon. So that's why you're getting this inversion in the yield curve. And this is kind of what we're watching. If you look back in 2000, right, you kind of had a similar story. And right before the crash in here in 2000, 2001 all the way to 2002, look at the inversion in here. I mean, it just kind of started back on a 1 year, and then the slope of the curve is the other way around instead of a normal. And then once you get out of the, maybe by the middle, and then once you the Fed starts cutting rates, right? Those shorter term duration, they start to drop aggressively. And then you're getting near that 0%, and then the yield curve moves higher like that. And then you start again a period of growth. And then, you climb higher, and then you go 2006, 2007, and then you invert again. And then you get the crash. Then the Fed starts cutting rate. You can notice how you're getting a drop at the shorter term yields, and you're going all the way to zero right there, right there. You're all the way to zero when they cut the rates. And that's at the bottom of the pandemic. At the bottom of the 2008, the great financial crisis. And then you're going to start to change again the slope of the curve, and you're starting to move higher, right? Those shorter term, yields, they stay near zero as Fed holds the rates up there. Then they start, going back, and they slowly will start increasing rates. And I don't know when that increasing rate starts, maybe 2015, 2016, all the way to 2018, when they break something. If you remember back in December of 2018, I think that's when Jay Powell kind of shifted, and then, they starting to cut him again. And here you are, you're dropping, and then you have the pandemic again. And, so you got a little bit of an inversion. Let's see, not much, but it was just more of a flattening before the 2018. And then you're moving up into 2019. I'm going slowly in there, flattening again. Right there, you got an inversion, see, between the shorter term rates and the medium term ones, like 5 year to 7 years. So this is not what's happening right now. I think when you hear people talking about the yield curve, they look at the 2 10s, they may look at, 3 7s, 3 10s, stuff like that, maybe 20, 30. But the one that actually indicates, an upcoming issue and an upcoming recession, it's actually the very short-term ones. When you look at the 3 and 6 months, and they have to be above, the 1 year to 2 year. And this is not what's happening at the moment, right? Right now, those very short-term rates are still very, very low, because the Fed is still at about, 25 to 50 basis points. And then you're getting an inversion between 5 and 7s and 10s, and maybe very briefly on the 2, 2 to 10. But nothing on the short-term duration. So that's why, I wouldn't get too excited about these news until actually you're seeing this shorter-term rates really, really spiking, and that's more indication of an upcoming problem in the markets. So just a little bit of a discussion on the yield curve here, so you can kind of go ahead and check this out. This is available on what's the name? Is it stockcharts.com. I'm not sure. I have a subscription here, but I'm not sure if it's available for free. It might be. But this is something where you can kind of see, and it's dynamic too, so you can basically animate it and let it, go on its own, and it will basically kind of show you what happens prior to market tops, and might help you in your decisions regarding where you are with your positioning, and when you need to pay attention to this yield curve. But it's just a little bit of a I wanted to kind of take you here, and then also I wanted to show you a chart of all the curve here, and you can look in the green ones. It's the 3 month, so 55 basis points. You can look at the next one in here, 6 months, in it's 1.4, and that's the SP 500 yield. And then here you are, the other one's kind of climbing. So you're looking at the 2 year, which is 231, and then the 10 year, which is 235. So it's only a 4 basis points there difference between the 10 and the 2s. So that's what that's what means the inversion, and I'll show it to you right here as well. Right here, you can see it, right? This is that 4 basis points difference right there, right? And when you're coming negative, you're supposed to kind of go below that 0 line. And this is the 2 year at the bottom at 231, and this is 235. So the difference is 0.04. So the moment you kind of go below this, you have an inverted yield curve on there. So that's all it is when you're looking at the yield curve. But that was just a page here showing you, how all the bond yields kind of look like, and how they're all kind of clustered up at the top there with very, very small differences in between them. You can look here when, the yield curve was nicely moving higher. Look at the 2 year, look at the 5-year, look at the 10-year, right? The 20, the 30, there's like, large difference in between them. And here they're all kind of clustered up, which means that you get a flattening of that curve, which could lead to issues in the market. And here's at the bottom, you got the S&P 500, and you can kind of analyze what's going on with that. And, now we're watching, hey, is this some kind of a fake rally? What's happening in here? And that's why I'm going to talk about, here into the next section. So before I move on to that, guys, please don't forget to subscribe to this channel. Come on. I know things are looking good here. I'm getting, more subscribers every single day, but for your new viewers, go ahead and subscribe, hit the notification bell. Let's continue to grow. Tell your friends about it. Leave some comments. We want to help this content continue to rise. This motivates me to continue to come up with hopefully good content counts for you guys that are interested, so you can learn Elliott wave. And if I see that happening, that kind of keeps me going. If I don't see people watching, or no likes, no comments, stuff like that, then I lose interest, and then then I just go on my own, and I just kind of, go in the program and do my thing, and just, trade every single day. But again, visit us in the program as well. I mean, the thing is cheap, darn cheap. And, you can come and, spend a month, a year, whatever you want to be in there, and learn about Elliott wave and structures and trades and stuff like that. And I actually this morning we've had a big, webinar, just a live stream about an hour and a half, where we went through a bunch of altcoins and discussions on macro and Bitcoin, and kind of where we are to the end of the quarter, the end of the month. So, just a little bit of a pause here to tell you about my program there. So guys, let me jump over and take a look at the S&P 500. So here is a longer term time frame. So we're looking back since 2000. And this is a big flat correction. I mean, it doesn't get any better than that. I'm sure you're familiar with this by now. I'm looking at this as a wave A, up in a wave B, and then down in C. So this is a, let's fix that for you. There you go. So, nice ABC. Was it a running flat? Barely, actually barely an expanded flat in here. Nice sell-off. Nice wave A, nice wave B. I mean, the whole move in here. I wish I could have identified that back when I kind of started getting involved into this markets in 2008, 2009, and I wasn't, nowhere near, in love with Elliott wave back then. I was trying all kind of different styles and things like that until I stumbled, across and upon Elliott wave methodology, and then I started learning it and diving deep into it, and it's become, my main method of analyzing markets. But looking back and studying, just a beautiful flat formation, I think, in a fourth wave, and it could be a wave too, for that matter, and then you can move out of here in a nice impulse in what it looks like another one, maybe another flat here in a 1-2. So 1 ABC for 2, another 1, 2, 3, 4, and 5 for a larger third wave, then another big expanded flat in a fourth wave. The reason why I count as an expanded flat is because of the nature of the sharp C wave drop in the pandemic. 3-wave rise to new highs in an AB up in C, 3-wave decline in an ABC. Very nasty flat formation, because everybody gets faked out to the upside. Then you get a big flush, go below this lows, ABC formation for what could be a fourth wave, or as an alternate second. So if you're looking at this wave as a wave 1, down in 2 instead of a 4, and then 1, 2, 3, 4, and 5, and you continue to climb. How does that happen? Well, you would have to have, obviously, a wave 1 up into these levels, and you have to make some adjustments here. So let me kind of delete this. Don't remove those waves, and you would have to go, let's say, in a wave 1 in here, and then let's do a wave 3, and then you'd go like this, right? 1, 2, 3, 4, and 5, and that would be wave 1 top, and then you go in an ABC, and that's your wave 2, and now you're beginning, let's say, another wave 1, 2 sequence that, lets you into the next larger cycle degree. So maybe this is going to be something like that, and then, then you continue to climb higher inside this, let's say, uptrending channel into the S&P 500. So, there's a couple of ways to look at this, right? You could have a wave 5 finish. Let me just kind of go back to that so I don't lose it. There you go. And you could be in a final 5th wave, and this move could be done here. You go in a 1, 2, 3, 4, and if this is a fifth wave and gets placed in there, right, that means that we've hit a big top in the markets, and you're going to sell off, and something is going to happen, and you're going to sell off at least all the way back there. If not, God forbid, all the way back to these levels, right? That would be the big major crash. I don't think that's the case. There's a lot of good companies out there. Something to trigger something of this magnitude, something very, very bad needs to happen. Either a big credit crisis, a big global war. I'm not sure what can trigger such an event, but I don't apply a high degree of probability to that. So, I want to stay with the uptrend. I want to stay optimistic about the economy. I want to stay, focus on the growth of technology and crypto assets. And, I just like to be more optimistic about the future than negative. So I don't, even though, this could tell you that there might be a major top forming in here, it's very, very premature to consider that. Like, think about this, calling a top, a wave 5 top of a market that's been rallying for years on end. You have to be, I don't know what's the right term, but very, very confident and very kind of cocky, for lack of a better term, to kind of say, yeah, we're done, and you're about to sell off, right? Like, listen, there is a lot more happening just beyond wave counts, and I want to be cognizant of that. So I'm gonna let this kind of develop a little bit more. It could be just on a lower time frame that you are maybe in a fourth wave forming in here. So I'm not saying that this move is done in here. It could be, but I think what's going on in here, we might get another fourth wave, because I'm looking at this kind of large correction in here, which is the biggest one of this advance, and then the next one that's quite large, it's obviously the current one. So we don't have necessarily a proper looking subdivision in here that would tell me that wave 4 of this degree happened prior to this high. So maybe what's going on right now, we're getting a little bit of a triangle in here for the next few months, and then we're going to push higher in a fifth wave, or in a wave 1, of this degree of strength, where you go 1, 2, and then another 1, 2. So it would be, if this is a cycle, the next one would be a primary wave 1, and then you get a sell-off in an ABC back. So this is kind of what I'm watching. I'm going to stay with this kind of fourth wave idea for now. Could this fourth wave be finished? Sure, this looks like a complex move, and then you can kind of squeeze back up higher from here and do a very small wave 1, wave 2, 3, 4, and 5, and continue to push higher like that. That could happen. So kind of going back to even a smaller time frame, I am watching to see, this to me looks, kind of corrective, right? Almost looks like you might have a WXY in here, or just an AB ending diagonal in a C wave. And then you're getting an impulse of this low. So every time you get an impulse, this should not be the only leg of the retracement. It should be just leg A of a retracement. You should do a B, and then you should do at least a C before you maybe do a wave B of a triangle, or let's say wave B of a complex move. If that's, let's say, a wave W at the bottom, and this is an X wave, ABC, and then you're going to get another decline, something like that, right? That could take us toward the middle of the year. So, wave 4 can take, any shape they really want. They could be zigzags, they could be flats, they could be triangles, they could be combinations. So there is a lot of ways that this could unfold, and we've just gotten the first decline. What's encouraging is that this decline looks corrective and is not impulsive, so it doesn't necessarily tell you that you have to break to the downside like that, So the only way that would happen is if this, for whatever reason, it is, let's say, some kind of a leading diagonal, and you're looking at this as a 1, 2, 3, 4, and 5, and this is a second wave, or wave A of a second, A, B, C, and then you're dropping lower like that, and you're creating a sell-off. So what do you do in this? What do you do in situations like this? Well, I always like to stay invested. I'm not going to sell my stocks just because, I see stuff like this happening in here. I want to hold through periods of, volatility, and I want to continue to accumulate stocks that come back to fair value, that are undervalued, things that look good. In all the sectors across, if they come into some good valuation levels, I'm going to watch those particularly. And even though I know that the SP500 is still overvalued, there's still a lot of stocks that have already sold off so much that they are bargains to these levels, right? And even though that you might hold them for a while doing nothing and moving sideways, you're going to generate income by looking at ones that get dividends, stuff that, companies that buy their shares back, things like that that you can accumulate. And then if you want to trade the market on a shorter term basis, then, you have to be aware of what's happening into the wave counts. And, we do this all the time. So I long NASDAQ back into these levels. We took profits. I took them a little bit early, so kind of back here. But I targeted the move all the way back to these highs. So there's ways to do that. Now, this is an impulsive. You can wait for a little bit of a correction. I think we might be a little bit long in the tooth here, just kind of coming back towards these levels. So maybe you wait for a three-wave setback, and then, that could be a nice opportunity to buy and then look for a move up higher. So you could trade that. You can wait for an ABC to be formed, and you can possibly, with the stop above the high, just short the move to the downside again. So there's ways to kind of do this inside. You got to be very careful, quite experienced in the Elliott wave methodology. Be patient, wait for the setups to form. But there's a lot of ways that people can generate income and make money. And the other one, it's options, right? So you can do a bunch of butterfly strategies and all kind of credit spreads where you're selling calls, you're selling puts, you're just looking to generate income for a market that's basically moving sideways like that, as long as these levels continue to hold. So the option world, it's really fascinating, and it gives you a lot of opportunities. It takes a little bit of time to learn these strategies, but we as traders, most of the time we're very, very directional, and we look for sharp moves in either direction. And sometimes the market just kind of chops along, does nothing, and by selling options, selling premium, you can generate credit, and you can continue to have a pretty decent income by deploying those strategies. So shorter term, I'm waiting maybe for a little bit of a pullback in here, and then if that happens in three waves and not too deep, right, you can use some fibs to kind of identify that. You can go up here and just see 38, 61.8% retracements. Those would be kind of as deep as I would like for this pullback to come back if it does happen, and then look to see if we're going to push higher. This could be a wave 1 and a wave 2. It could be a wave A and a wave B. All right, so that's kind of where I'm at. So I hope this helped. I mean, there's no real magic about anything in the markets. It's just a lot of hard work. Studying the wave counts, making sure that you know what you're looking at and you understand what you're seeing, and just be patient, be careful, and have a game of attack, a plan. And then when you're wrong, just get out of it. Just get out of it. There's you're going to have a clean mind. You're going to get back to the drawing board and, do it all over again. And every single year, things are going to get a little bit better, and, you'll be able to identify much better setups much easier. So with that, guys, I'll leave it at that. Enjoy the rest of your weekend. I'll see you everybody back here on Monday. Don't forget to subscribe and like, and visit me in the Pro Room. And I do videos like this every single day, every single morning, and then we do updates on Bitcoin and as much alts as I can cover in there, and stocks, and we have a portfolio of stocks that we buy, and I monitor that every single day. So thanks for watching, guys. I love you all. I'll see you later. Bye bye.